Before we dive in, please keep in mind that trading foreign exchange and financial products involves significant risk. This video is for educational purposes only and does not constitute financial advice. You are solely responsible for your own investment decisions. Let's start with the basics, the anatomy of a candlestick. In a bullish candle, the closing price is higher than the opening price. The space between them forms the candle body, while the wicks show us the high and low points reached during that period. Now that we've covered the parts of a candle, let's talk about the candle range. The range is the total distance between the high and the low. Understanding this is crucial because the range measures market volatility during that specific time frame. A wide range shows a major battle between buyers and sellers, while a small range suggests indecision or a lack of interest. By looking at the range, we start reading more than just numbers, we're reading the actual intent behind the price action. Now let's look at the opposite scenario, the bearish candle. Unlike the bullish one, here the opening price is at the top and the close is at the bottom. This tells us that, during this period, sellers were in full control, pushing the price lower. Just like before, we have the high and the low, representing the price extremes. It's vital to track the length of the red body. A large body confirms solid selling pressure, while long wicks at the bottom might suggest that buyers are starting to fight back. Let's take a deeper look at the bearish candle body. As you can see on the screen, the body is defined by the exact distance between the opening price at the top and the close at the bottom. Why is this so crucial? Because the size of the body tells us the strength of the seller's conviction. A large, solid body, like the one shown here, indicates that the bears dominated the session from start to finish, leaving very little room for buyers to regain any ground. If you spot large bearish bodies breaking through key levels, it's a clear signal that the momentum is heavily on the supply side. Learning to identify the relative strength of these candle bodies is what separates a beginner from a professional trader who truly understands how to read the sentiment behind the price action. Just as we saw with bullish candles, the candle range in a bearish candle covers the total distance between the high and the low. However, in a bearish context, the range takes on vital psychological importance. A very wide range during a price drop is often an indicator of panic or a massive sell-off. Looking at the image, the distance between the wicks tells us how far buyers tried to push before being overwhelmed by supply. The range allows us to measure volatility. The larger the range in consecutive red candles, the stronger the downtrend and the riskier it is to look for an immediate bounce. Understanding the range is like reading the market's fear thermometer on the chart. We are now diving into one of the most powerful concepts in price action, the fair value gap, or FVG. As you can see on the chart, an FVG is an imbalance or inefficiency that occurs when the price moves so rapidly in one direction that it leaves a liquidity void behind. In this image, we have two FVG levels marked on a 12-hour time frame. These gaps act like magnets for the price. The market has a natural tendency to return to these areas to fill the inefficiency and balance the buy and sell orders that were left pending. Identifying these gaps gives us a massive predictive edge, as they often act as hidden support or resistance levels where the price tends to react precisely before resuming its original trend. Now, pay close attention to what's happening in Capture 7. After that strong bullish momentum, the price begins to pull back, targeting the upper fair value gap we marked in green. This is the rebalancing phase. As price action traders, we don't chase the market when it's surging, we wait patiently for it to return to these inefficiencies. Notice how the current candles are starting to tap into the 1.17110 zone. What we're looking for here isn't just for the price to reach the level, but how it reacts to it. Will we see a rejection? Will long wicks appear, signaling that buyers are defending this level? This is the exact moment where theory turns into a potential trading opportunity. If the FVG holds, we'll have confirmation that the bullish trend has a solid foundation to continue its move. Take a look at the surgical precision of this move in Capture 8. The price tapped the upper level of the fair value gap at 1.17110, and buying pressure stepped in immediately. This is what we call inefficiency filling with continuation. Notice how the current candle has rejected the red zone and surged upward with momentum, breaking above previous local highs. This is the validation every price action trader is looking for. The 12-hour FVG acted as massive institutional support. When this happens, it gives us confidence that the imbalance has been mitigated and the market is ready to target new liquidity pools above current prices. It's not about guessing, it's about reacting to what the chart is clearly telling us. Buying interest remains very much alive in this pair. We are now moving on to one of the most critical concepts in institutional strategy: order blocks. In Capture 9, you can see two levels clearly marked in green and red. An order block represents the last candle before a strong, expansive move. It's essentially where large institutions left their pending buy or sell orders. On this 12-hour chart, we've identified two key zones, one at 1.15950 and a deeper one at 1.15436. These aren't just simple support lines, they are high-probability zones where we expect the market to return to seek liquidity before continuing its path. Learning to mark these blocks correctly is like having a map of the footprints left by the big players in the market. Keep these levels in mind, because their reaction is usually a game-changer for our trading setups. Take a close look at Capture 10. The price has finally returned to our zone of interest, the first order block at 1.15950. Notice how the market doesn't just slice through this level, instead, we see the price starting to stall right at the green line. This is what we call mitigation. The institutions that had pending orders here are now starting to execute them. As price action traders, this is a high alert moment. We don't just enter because the price arrived, we watch how the candles form within this zone. If the level holds and we start seeing rejection, we'll have confirmation that the order block is acting as a real institutional support, giving us a high probability setup for a potential reversal or bullish continuation. Once the price has reacted to our demand levels, we must identify where it is headed. This is where buy-side liquidity, marked as BSL at 1.17288, comes into play. These levels represent previous highs where sellers typically place their stop losses. For large institutions, these points are pools of liquidity needed to close their buy positions for a profit or to induce new buyers to enter the market at the wrong time. The price tends to gravitate toward these levels like a magnet before making a major move. Identifying BSL allows us to set clear exit targets and understand the narrative behind price displacement. The market doesn't move randomly, it moves from one liquidity pool to another. Pay close attention to what's happening at this point on the chart. The price finally reaches and decisively breaks through our buy-side liquidity line at 1.17288. Notice that upper wick sticking out above the level. It's a clear technical sign that sellers' stop losses have been triggered and absorbed by large institutions. To a beginner trader, this might look like a bullish breakout to go long, but for us, it's the signal that the target has been met. The market has found the fuel it needed for its next move. Once liquidity is taken, the price often pulls back, so our priority now is to lock in profits and avoid the trap of chasing the move too late. Just as we identify targets at the top, it's equally crucial to look below. In this scenario, we encounter sell-side liquidity or SSL, located at 1.16456. This level marks previous lows where buyers' stop losses are clustered. For the market, these points represent liquidity pockets that act as a magnet for the price. It's vital to understand that institutional trading is based on this pendulum motion, moving from buy-side liquidity to sell-side liquidity. By marking this red zone on our chart, we aren't just pointing out a support level, we are identifying the area where institutions might seek a counterparty to initiate new positions. Whenever you see a strong move, ask yourself, where is the nearest liquidity? In this case, the answer lies clearly at the bottom of our current range. Finally, notice the precision with which the market moves toward our downside target. The price doesn't just reach the sell-side liquidity zone at 1.16456, it pierces through it to sweep the stop losses of retail buyers. This is the ultimate confirmation that liquidity is the primary engine of the chart. We've seen how to identify structure, locate inefficiencies, and understand where institutional money is headed. Mastering these price action concepts doesn't happen overnight, but understanding that the market moves from one liquidity zone to another is the first step toward stop being the liquidity and start trading with the institutions. Analyze your charts, look for these footprints, and you'll see your trading perspective shift completely. See you in the markets.